Hi, I'm Patrick from freefincal, and today let's take a look at SBI ETF Nifty 50 versus UTI Nifty 50 Index Fund. The SBI ETF, the exchange traded fund, has almost 65,000 crores in AUM. Much of it is because of the EPFO. They've invested in that, and if you have a casual glance at it, there will not be much of a difference between the price of the ETF and the NAV. So it looks like it's possible that's a potential investment option for you because it's got a expense ratio of 0.07%, whereas the the UTI fund has got an expense ratio of 0.1%. So should you use the ETF because of that? Let's find out. So before we begin, we should understand a couple of things about an exchange traded fund. An exchange traded fund is like a stock. The units of the exchange traded fund will be treated like as if it's a stock, but it will be traded among a very small pool of unit holders. All the unit holders of the ETF will be trading the units of the ETF amongst themselves. So there is something called the price of the ETF, and that price will be set depending on the demand and supply of the units and how robust the trading is in the ETF. If there is excessive trading in the ETF, the NAV of the UTF and the so if that's the NAV of the ETF, the price will move up and down. It will oscillate above the NAV. So if it goes up too much quickly, it will come back down. If it goes below, it will quickly come back up. And even if there is not good trading in the ETF, there will be an intermediary appointed by the AMC who can profit from the price NAV arbitrage and make sure that the price of the ETF is kept close to the NAV at all times. So certain ETFs are very good in this. For example, ICICI Ivan Midcap ETF has got a very small price NAV difference, although it's got a few crores in AUM. Whereas this SBI ETF has got 65,000 crores, and you will see that if you look at the ETF price minus ETF NAV divided by the ETF NAV. So the percentage deviation of the price with respect to the NAV. Notice that up to about March 2017, it was hovering around that zero. So ideally, the deviation of the price from the NAV should go above and below the NAV. That's when it's a robust ETF. But since then, since March 2017, the 0% line is here. It fell down one step and then it fell down. It's almost trading 2%. So the ETF price is 2% below the NAV. That means that the ETF is trading at a discount. What does this mean? This means that there is practically no demand for the ETF. I mean, people are. If you want to buy the ETF, it's available at a discount. But then, please recognize that unless the EPFO sells it, individual investors will not be ready to sell things at a discount. Suppose I am holding a ETF and you want to buy it. If you want to buy it because it's at a discount, but if I sell it, I will get a loss because it's at a discount for me too. So the liquidity would be low. Of course, there will be some liquidity created by the institution. Because if anybody who is losing money, it's the EPFO who is losing money because of this 2% discount available, and it's a consistent discount since April 2018. That's shambolic to say the least. Just this fact alone should be enough for you to not touch this ETF, not touch any ETF which is having such a persistent discount or premium to the NAV. That it's a sign of that means that you will have very difficult time buying and redeeming large amounts of units. The other thing that you can look at is that you can find out the index return. Excuse me. Yeah. So you can look at the index return minus the index fund return. So the blue line that you see here is the quarterly returns. We are taking quarterly returns, and we are taking the quarterly returns of the Nifty 50 index and minus the index fund, UTI index fund return. That's the blue line. The red line is the index return minus the ETF NAV return. And if you look at the ETF NAV, that's actually quite low because the NAV is a much more stable thing. Those spikes are spurious data. Don't worry about that. And if you look at this data, it looks as if that you would lose a lot more because because of the expense ratio of the UTI index fund. The the return difference is significant, whereas in the ETF the return difference is quite small. This looks as, if you look at this alone, you will think that the index fund is bad, but that is wrong, because many people make this mistake of looking at the ETF NAV in terms of returns. The returns are never calculated in all these portals and by the AMC using the price. They always use the NAV, which is a big mistake. And they also calculate the so-called tracking error with the ETF NAV. That is also a mistake. Whereas the situation will be completely different if you use the ETF price. So again here the blue line is the index return, quarterly return minus the index fund return. The red line is the index return minus the ETF price return, the return based on the ETF price. And you see how volatile that is and how much it can swing back and forth up with respect to the index fund return difference. So it's extremely volatile because of the deviation is extremely volatile because of the demand and supply in the ETF pool. And because of this, you can't simply say because the index fund has got a higher expense ratio, it's a bad option. The ETF is a better option. You should always learn to look at the ETF price data. Calculate returns using ETF price, not NAV. Calculate tracking ratio using ETF price, not NAV. When you do that, you will recognize that most Indian ETFs are quite expensive and the index funds are always a better choice. So that's what I wanted to say. Catch you again later. Bye bye.